Hey there, my name is John Stevenson. Welcome to the show. We're going to be talking today about whether or not annuities are as good or even better than a 60-40 portfolio split. Now, this is very common with a lot of retirees. As we get older, we usually, not all of us, but a lot of times we want to get out of risk, okay? But we still want some returns. And so a lot of times what we'll do is we'll throw our money into a portfolio that is more risk adverse, allows us to get some of the gains of the market, not all of it, but also allows us to not go down as hard, go through the floor when the market crashes. So it's nice. It's nice if the market crashes 20%, maybe our portfolio will only go down 10% or 5%. But of course, when the market goes up 30%, we might only get 18%. So there is a cost to it. Now, with annuities, you can get pretty good returns right now. And they're very comparable to the 60-40 split. The difference is you're not in the stock market at all, okay? You don't have any market risk. And when the market drops, you don't lose a dime. So your emotions are not going to be the same. Even if you're in a 60-40 split and the market does go down, it still might be an emotional ride. It won't be as bad as being in pure stock, but it's not going to be the same. So I'm going to show my screen. I'm going to share how these can work for you. But I would say when we look at 60-40 splits, the average returns are usually between 7 and 9%, depending on the portfolio. So yours might be a little bit less, might be a little bit more, but I would say let's just keep the average around 8%, which is pretty good. That's really good. And, I'll take that all day, right? But if you want more growth, you keep it all in stocks or keep it all in the S&P 500, and of course you're going to make more. But when the market drops, it's not going to feel very good. Okay, it's going to definitely be more pain than a 60-40 split will do. With annuities, though, especially with indexed ones, you can get pretty decent returns. And I'm going to show you, and we'll find out together what those average returns are. And there's certain companies, there's certain indexes that I recommend over others so that you actually get the returns that we're illustrating, because I'd rather you be able to have your expectations set correctly. And a lot of times people are sold an annuity with bad expectations and they get ripped off and they get really mad, which I don't blame them. So we'll look at index options and we will look at the MYGA options, because MYGA options are pretty darn good. I mean, they're close to index options. So you might just want that and call it a day. So there's a lot of good options with annuities right now, and I'm here to show it to you. Okay. So if you want to purchase an annuity for yourself, you're looking for someone who you can trust, then I would invite you to book a call. There's a link below this video. It goes directly to my calendar, or you can go to my website, johnstevenson.com, and you can book a call with me there. So you'll notice there are a lot of calculators on my website. You can check out different annuity payouts, but for growth options, the only calculator you will see is a MYGA. For fixed index annuities, I don't have a calculator for those because indexes change all the time, and there's like over 4,000 of them. Okay. And so it's very, it can be misleading because a lot of indexes show huge returns, and they show like 20 to 30% returns over 10 years. And you're like, wow, this is great. I'll get this. The problem is it's only showing it for 10 years because they're back tested results. They actually haven't been in the market, or if they have, it's only been for like a year or two. So anyways, lots of things to think about when you're thinking about purchasing an annuity to maybe give you some growth, market protection, and perhaps replace your 60-40 split. Maybe you don't want to be in the stock market at all, but you're looking for an alternative, a viable alternative that's going to give you some decent growth. Okay. All right. So looking at my screen, I'm going to show you the MYGAs first, just so we can get that out of the way, and I want you to see the fixed rates. Okay. If you look at the MYGAs, you will notice that you got the top three in each of these terms. They're typically from 2 to 10 years. There are a few states that will do 15 or 20 years, but most you just check my calculators. Most of the time you will not see those. All right, so when you look at, let's see, I'm gonna go to 5 years. 5, 7, and 10 years are the best options for these for growth, and I'll show you why. You can see here's the 5 years, 5.7. Okay, look at the 4 years, 5. Okay, 3 years not bad, 5.45. Then you got 5% on the 2 year. Okay, but if you look at the 5 year, the top rates are like 5.3 to 5.7. So definitely pick Exonic if you want the highest rate for a 5 year. If you go to, let's just see what the 7 years are. You can see the 6 years, 5.5. The 7 years not bad. 7 and 6 actually pretty comparable. That's not always the case. But right now it seems like they are looking pretty good. So that's nice. And then you look at 8 years, 5.25, not so good. 9 years, 5.25. And then we're back up to 5.5 for the 10. So rule of thumb, it's usually 5, 7, and 10. Okay, not always, but usually. So, but these are fixed rates. They're fixed. They're guaranteed. You don't have to think about it. So if you were, let's say you went for the 7-year, okay, 5.5%. You did Exonic. So they're very simple, bare bones. They're like a CD. Okay, you don't pay fees, and you get tax deferred growth, even if it's cash. So that's very nice for non-qualified funds because you can't do that with a CD. But you can see with this, absolute guaranteed growth. Okay, 27,500 the first year, and then it keeps compounding. So over time, you're going to have 227,000 in earnings, 727,000 in total account balance. So that's great. That's guaranteed. It's definitely not going to beat some of these index options that we're looking at, but it's guaranteed. Okay. So that's nice. It's really nice to have that. All right. So let me go back here. Let's just see. I just want to see if there's any, you know what? There's one other thing I didn't show you. These are A- and higher. I'm going to show you any rating now. All right. Let's take a look at this. Okay, 2-year, 5.25, 3-year, 6. Wow, look at that. Mountain Life. Now B-, B+, just be aware that that's riskier. Okay, they're still good companies, but if they don't have, the asset liability ratio where AM Best wants them, then they're going to have a little bit more risk. So you can always keep it under the state guarantee amount, but you just have to realize there is more risk there. So just keep that in mind. All right, now we'll go up and we'll say, all right, what's the 5-year? Well, the top one is American Gulf. Okay, 6.3. Wow, pretty good. This one does not allow withdrawals, though. So if you want one with withdrawals, I'll actually give it to you for 6.15. So anyways, that's still not bad. Okay, now if we go and we look at the 7-year, same thing. So let me pull up. I'm just assuming that you're going to want to take interest out. Maybe you don't, but let's just say you want to. Okay, this one allows it after the first year. So if you were to pull this up, I'll show you the growth over 7 years. 6.15 compounded interest grows to $759,000. Pretty good. Okay. I've got clients with these. They're doing very, very well. And 6%, it's not probably the 7 or 8 that you can get from the 60-40 portfolio, or we'll find out whatever the index is, the index annuity option. But it's pretty close though. That's what I'm saying is when you have good rates like this, it's worth looking at. All right. So now we're going to go up. We'll say 10 years. Okay, look at that. We got a 10-year with Wichita for 6%. Now, this is out of Nevada, okay, and the other states that Wichita will sell in as well. I was just looking at this today, and they don't sell it in California. So there are certain states that have these and certain states that don't. So you just have to check my calculator and find out for yourself, okay? But this one, if you were just to throw it in Wichita and just let it sit and run and do nothing, okay, it doesn't allow any withdrawals. You just want the highest growth rate for the longest time period possible. Then there you go. 500 grand is going to grow to 899,000. Okay. You can see the compounded earnings here. You take out your 899 grand and then you roll it over into something else if you want to. So take it out and spend it. Whatever you want to do. That's what's nice about these is you can lock in some growth. It's guaranteed. It's boring, but there's no market risk. So when the market drops, you're not partaking in any of that mess. All right. Okay. So now that we've looked at those, okay, let's talk about the index options. Can we beat the 60-40? Okay. Because 60-40, as we're, we've been talking about, it could be 7%. It could be all the way up to 9, but you are subject to market risk. Okay. So let's take a look. So I'm going to go in here and we're going to look at all of the indexes. Okay, there's a ton of them. So I work with all of these companies and all these indexes, but there's only a few that I recommend. And when I say a few, I mean like I can count less than 2 hands, okay? Because I want to put you in something that I know is going to have the best chance of success for you. And there's some other options out there that I'd love to sell, and they pay me higher commissions, but I don't recommend them because you're going to hate me after a year after being in them because you feel like you got sold, and people don't want to be put into something that they regret. All right, so here's the first page. You can see there's like 3,700 results here just on this page. So if you look at these 10 years, remember how I was talking about hypotheticals? Okay, they're showing huge returns. Okay, it's because they're using indexes that are, and this is actually the Annexus product by Athene. So I'd have to pull up this illustration in another window, but let me go down. I'm going to pull up, let's see here. A lot of Annexus products. Okay, let's look at some more here. Annexus actually partners with Athene and Nationwide, and a couple others for providing other products, but they use the insurance company's ratings, and it is covered by the insurance company. But they're all about trying out new indexes, okay? And some of them work, some of them don't. But you have to realize if you go into any of these, you might be the guinea pig, okay? So I'm going to show you right after this which ones I recommend, but I just wanted to give you an idea what some of these look like, okay? All right, so let's see. What if I grab this one? Let's just see what this would illustrate as. This will kind of give you an idea on some of those. Okay, you see NASDAQ, and you're like, oh yeah, NASDAQ. Yeah, NASDAQ. It's been around forever. Well, guess what? Not this one. This is since 2020. Okay, so it's a variation. It's kind of like the S&P Mark V. You think, oh, that's the S&P. Well, guess what? Compare the S&P Mark V to the S&P 500, and you'll realize the S&P 500 is way better, and the Mark V has been underperforming like terrible. Just look at it. You'll see. So you'll see these indexes, and you're thinking they're the pure index. They are not. Okay, you have to make sure that they are the pure index. And this one has a annual fee as well, and they get a participation rate of 225%, which means if it does 10%, wow, you're gonna get like 22%. Pretty good, right? That's if it does it, okay? It's a new index. So they show you, all right, here's what it looks like with the fee, okay? The account balance if there is no growth, okay? They show you worst case. And then they show you, but here's what it's really going to do. In 10 years, it's going to grow to almost $2 million from 500 grand. You're like, wow, that's great. Sign me up. The guy makes a huge commission who sells it to you, right? No, I don't recommend this, okay? If you're going to go into any of these growth options with the index, you have to look at the allocations. Okay, in the allocations here, you can see, let's see, live since 2023. Okay, 2023, 2020, 2023. You see what I mean? A lot of these it doesn't mean they're going to do bad, but a lot of times they do. Okay, a lot of times they just don't do what is illustrated. And so people get stuck in these, and there's a long surrender charge period, and they can't get out. And they're stuck with these mediocre returns of like 2 or 3%. That's what I don't want you to have. Okay, if I was to go down, let me just see here. Look, they actually have an S&P 500. Okay, this is the pure one. Okay, and they're charging you a fee for it, 1.25. Okay, so I'm going to do 100% in that. Okay, because that would be something that I could actually, be comfortable illustrating for you. If I do that and I try to go against a broker who's trying to sell you something that's showing you more growth, he's probably going to get your business because he's going to make it look better. Okay, but I want you to actually get what's illustrated. So you can see here, it's probably going to grow to 900 grand. That is something more likely. But then at the same time, you have to remember this is with a company also that I've seen them lower their cap and participation rates quite a bit. And if that happens, this amount is going to be lower. Okay, I don't want that either. So then I start looking at companies that first I want the S&P 500 index, and I also want a company that has a reputation of keeping those rates pretty constant year after year. So for this example, and like many of my examples, I'm going to show you Delaware. Okay, so we're going to go in here and we're going to say, I only want to see Delaware. Okay, I know this is kind of a long, drawn-out video about how to replace your 60/40 portfolio, but I think it's important enough. If you're thinking about seriously replacing your portfolio, I think it bears in mind that we should have a video long enough to really show you some tried and true methods on being able to hopefully match it or even more, and be able to protect yourself against the market risk. All right, so we'll say S&P 500 only, and not only that, I want it to credit interest on an annual basis. I don't want to see any of these, I don't want to see these 2-year or 10-year options. I want more compounding, okay? Okay, so there's their best one right here. So let's pull this up. They do have a cap here, 11%, and look at that. There's no fee for it. See what I mean? And Delaware is known for keeping their participation rates pretty constant year over year. So that's what I would pick this over the other one, okay? So if I pull up the participation rate, though, it does better than the cap. So, and you'll see, because when the years are good, you're doing better than 11. All right, so here's the worst case. Worst case is there's no fees and the account balance stays where it is. Pretty nice, huh? Then if you look down here, it's projected to grow to $1,079,000, okay? Even better than the other Athene, the illustration I was showing you, but it's also, I'm now showing you an illustration with a company that has a reputation of keeping their participation, their cap rates pretty high year over year, okay? So based off of this, you can see the good years, 15, 14, that's pretty good, okay? Now there's no guarantee they're going to keep their participation rate at 55, but they have a higher likelihood of doing it versus a lot of other carriers that I work with. They have that reputation and they try to maintain it. That is what I like. Okay, so when I make recommendations, I'm basing it off of that. Okay, so there's no guarantee on any of these. You can pick a Mass Mutual, or there are some other ones where they'll give you like a guarantee cap of like 7 for 7 years. That's not bad. But the earnings on those are just a lot less. So you're almost better off with those just to get a MYGA if you're going to do one of those. But for these, this is perfect. So you see, you could have a lot of growth. You have a lot of market protection. You get some of the index because they're buying call options associated with the indexes. And they're giving you a portion of the earnings, not all of them, because there are years where they can't exercise it. So they got to be able to recoup those costs. But you can see over time, it has a pretty decent growth. Okay, it's not going to beat a stock portfolio, but it's not meant to. It's meant to give you that market protection and give you the growth. And you'll notice here the average annual effective rate of return is 8%. Okay, and they're basing that average off the last 10 years. They're showing you if the market continues to do what it's done, and we have the years where we can't exercise those call options because the market's down, then this is what your average will be around 8%. Which is pretty close, I would say almost side by side with a 60-40 portfolio split. The difference is you are not subject to market risk. So when the market takes a dive, the only thing that happens is your account stays the same. So when 2008 happened, and when the tech crash happened before that, when we had a crash in 2020, all of the annuity holders of these types of annuities saw no change. It just stayed right where it is, waited for the next uptick. Okay, that's how it works. All right, so this was a long video. I hope this was helpful. If you're looking to purchase an annuity for yourself and you're thinking about replacing your risk with some guarantees and protection, then book a call with me. There's a link below this video and there's a link on my website, johnstevenson.com. And you can play with my other calculators. If you're looking for lifetime income, there's some great options for that. I have a lot of clients that will use a portion, not all of their portfolio, but a portion of it to buy income for themselves, to buy a pension. And you can do that with SPIA, DIA contracts. The income rider usually pays the most, but you can do it with any of those annuity contracts. And then if you want to leave the rest of your money in the stock market, you can do that. Or maybe you want to throw it in one of these where you can have market protection and still growth. There's nothing wrong with it. You just have to kind of decide for yourself what you are comfortable with, what kind of risk you want or don't want for yourself. So anyways, hope this is helpful. I'd love to help you purchase an annuity if that is what you're looking for. If not, enjoy the video, enjoy the website. And until next time, we'll see you soon.